afternoon, everybody. Welcome to our webinar. The end of July. Can't believe it. We're 7 months into the year. But welcome to our webinar. Those who have joined us and those who are still coming in, welcome. This webinar is being recorded. Any questions you guys have, just type in the question box. Hopefully, I'll be able to answer your questions. But I'll have a slot for any questions that you might have. So let's kick off. So July is National Savings Month. It's an initiative designed to obviously encourage individuals and households to develop, number one, obviously healthy financial habits, but also the idea is to prioritize saving for a more secure future, financial future as such. So in the face of reduced disposable income, things are tough at the moment. Saving may be difficult for many people, but with the right strategies and the mind shifts, it could just be in reach. So good day, my name is Sean van den Berg. I'm an investment specialist here at PSG Wealth. Welcome to our webinar. My goal today is to explore practical ways to save, even in these tough financial times, but also to discuss ways or the relationship between saving and investing. A lot of people think it's the same thing. It's different. Okay, so here's my little agenda. We just move to the next one. There we go. There's my quick little agenda, my 3 points as we always have. Obviously, I'm going to spend a lot of time on budgeting as such. I believe that's a very important part, and I think a lot of people don't do it. We're going to touch on the importance of saving, and then we could just talk some of the investment products that PSG can offer you to help you meet your savings and investment goals. Okay, but saying that, just to give you some context, globally, the focus on saving money varies obviously significantly by country, by region, but also by demographic group. So just as a quick, as a side note, I've just got these 3, call it high saving, moderate, and low saving countries. So South Korea leads obviously with the average saving rate of about 35%, which is quite amazing. Sri Lanka follows that with 30%, and then Sweden's at 25.36%. Moderate saving countries, most of obviously European nations like France, 17%, Germany 11%, and the UK shows us a moderate savings rate of about 10%. Quite interesting that the United States, only 4.8 of disposable income is saved. Australia just 0.6%, and then right at the bottom there I've got South Africa. So a negative savings rate of minus 1.1. Obviously, this indicates more spending than saving. But also you can look at some other key insights. Europe, as such, tends to have a higher savings rate due to stronger social safety nets, you call it that, and then also obviously cultural emphasis on financial planning. Asia, for interstate, it shows a mix with countries like South Korea saving aggressively, but also Japan's rate is relatively low, about 5%. I always thought it was the other way around, that Japan saved a lot of money, but it's down to 5%. So yeah, this is just some figures that it's a snapshot, call it that snapshot of savings habits that's based on the latest data coming out this year. And then, as I said just now, that the North America and Africa generally show low savings rates. This is obviously due to higher living costs, debt levels, and economic instability. Specifically with South Africa, obviously we're on this negative savings trajectory. It's a lot to do with we're consumption-driven economy, where households are increasingly relying on credit. You know, we've got the champagne lifestyle, but we're living it on a bare income. So yeah, we're living in debt, we're living on debt, and that's a challenge for us. So this pattern obviously has worsened over the years on the back of low economic growth, high unemployment, and obviously the rising living costs, which is obviously outpaced income growth. But also just interesting, in the US, 57.4% of people have less than $1,000 in savings. Okay, it's quite interesting if you think of that. They have an emergency, a lot of people will be in a lot of trouble. 50% of women aged between the age of 55 and 66 have no retirement savings. I've touched on this before in previous webinars. So globally, men are more likely than women to have substantial retirement savings. So I thought I'd just put that in quickly before we kick off and look at more about budgeting. So what is a budget? A budget is a personal spending plan. Okay, so it considers obviously expected income and expenses for a specific time period or specific period. It takes what you spent last month and anticipates what you'll spend this month. Okay, I know it's very basic, but you know, if we all of us do this, I think our financials will be much better. So, and I have harped on this before in previous webinars. But as I say, it is savings month, and this is where it all starts with a budget. So budgeting should be like brushing your teeth, yeah, just part of your life, whether you like it or not. So there are many reasons to have a budget. So it obviously depends on the individual. So just to give you a quick call it overview, as having the right mindset and shifting your strategy slip firstly. That's your the first thing I want to talk about is just having that right mindset. So it's prioritizing savings as a non-negotiable expense. I've spoken about before in previous webinars where you treat a savings or investment as a fixed account, like you would do if you're paying your rent or paying your telephone account. You know, it has to be done. It has to be done all the time. So even small amounts saved consistently can grow over time. So we spoke about this before, where pay yourself first, and I think you can do that and get into that habit. Things will fall into place. So it's obviously set clear, achievable goals. I always say to people when they phone in and they want to start investing, what is your goal? Why do you want to invest? A lot of people don't have an emergency fund. We've spoken about that also before. You need to save between 3 and 6 months income just in case something happens. Your goal might be overseas trip, or it might be a retirement, whatever the case might be. But having that as a purpose just makes it easier to stay committed. And then there's various ways of doing it, various guidelines. We've spoken about also this 50-30-20 rule principle. 50% goes to your needs, obviously your bond and your petrol and food and things like that. 30% goes to wants. Now you can still spend you worked hard for your money. You want to spend some on yourself, be it for entertainment or clothes, whatever the case might be. But 20% must be allocated towards either savings, or if you got debt, clearing the debt as fast as possible. So the idea here is, you know, if 20% is not feasible for savings, then start with 5 to 10%, and then gradually increase that. Okay, and then budget as a second headline. Budget adjustments to enable savings. So we start tracking your expenses. And the whole idea with this is to find the money to save and invest. That's what we're trying to do here. So there's we can use budgeting apps. I use Capitec, and I've got a nice little budgeting thing inside Capitec's app. I also use the Excel spreadsheet. The whole idea is to manage where your money is going. Where is it coming from and where is it going? So that's creating that awareness. I think that's a very important step. A lot of people don't really know where the money is coming from, and a lot of people don't know where the money is going. Okay, that's scary. So as I said, the idea is to find money that you can save. So cut back on those unused subscriptions that you're not using. It's amazing. I went through the other day and I found the subscriptions that I'm paying for, I'm not even aware of, and I'm not even using it. So it might be a few rands here and there, but it does add up. Cook at home more often instead of eating out and getting takeaways. I know sometimes might be more convenient, but you do save money. But it's also, remember, it's that discipline, getting to that habit. And then right at the bottom, if you can automate these things, as soon as money hits your bank account, let the money be automatically transferred into various savings vehicles and things like that. Just makes it easier and to avoid that temptation to spend that money. Okay. We've spoken before about money jars. You can also use an envelope, but the idea is that you put these money into all these separate accounts, allocated for for entertainment or allocated for dining out. But if it's gone, it's gone. Okay, you don't dip into any other jars or any other envelopes. And then obviously also, you can either cut back or you can also increase. You can also increase your income. So look at the ways of creating extra income, be it freelancing or selling unused items in the garage. But as I say, every small amount helps boost those savings accounts. And then also very importantly is review and adjust monthly. So if you can work towards it all the time, and you see this progress, it will also be a big motivator. Okay, so I hope that made some sense to you guys. So let's touch quickly on the importance of saving. So obviously financial goals will differ from person to person, but the common thread should be that you're putting aside money today to use later. That's our idea. Saving for a rainy day. We've all heard that expression. So that's our idea. It's no wonder that this is often called squirreling money away, like a squirrel. Obviously, the idea is to save the nuts in summer. We save the nuts in summer for the winter. Okay. So, but being disciplined enough to save for your future, that's where they get difficult. So obviously saving does help you to build financial security. It helps you achieve a lot of personal goals. So it just gives you that peace of mind. I think that's what's important here. So a well-funded savings account can give you that financial freedom to make better decisions. And obviously that will impact your life or impact you more financially as such. Okay, so let's talk about some ideas here. So the importance of savings. Obviously, long-term security. We talk about a emergency fund. So if emergencies will pop up, is to have that nest egg, or not a nest egg, that lump sum saved up between 3 and 6 months expenses. So that's that safety net, gives you, as I said, that peace of mind. You're better prepared. So that's the idea, yeah. So that's it's a starting point. And then also you want to save towards financial independence. That should be a goal. What does financial independence mean to you? You want to be debt free. You want to be self-sufficient. You don't want to, as I say, living a champagne lifestyle and be an income. You want to be self-sufficient and be able to live your life as you want to. Okay. And then let's talk about having enough money to have that choice to start a side business or explore other interests you might have, but because you've set this money aside. Okay. And I found also very importantly, if you got savings in place and the emergency fund, it just reduces stress. We all know that obviously it's one of the contributors to divorce in South Africa, people fighting about money. But just your health is more important. So it does have an impact there too. And then obviously we spoke about this before in previous webinars, the magic of compounding. Where your money makes more money. So and obviously when you put your money into a bank account, it doesn't really grow fast. It's when you start investing and chasing growth. That's where we see the big benefits there. Okay. So sorry, let me just get some water here quickly. So I thought I'll just highlight the differences between saving and investing. So there's 4 things we can look at. Obviously, your time, the period, the access to the money, the risk, and then obviously the growth. Those are the 4 main things. So when it comes to saving, obviously the time horizon is a bit shorter, but you're saving towards a specific goal, be it an emergency fund or a holiday fund, but it's a bit more shorter. But it's a specific goal. I need X amount of money in a certain period of time. Okay, so when it comes to investing, obviously a bit more longer term. So this can be 5 years plus, 10, 20 years, but it's usually the bigger goals as your children's education, your retirement, things like that. When it comes to accessing your money, putting your money in a bank account, is important, especially when it comes to your emergency fund. You want to have some funds being able to, the flexibility to access those funds as soon as possible. Worst case scenario, you might be involved in a unit trust account. Unit trust account. The worst case scenario, it takes 3 days to, sell the units, and then another 2 more days for the money to be in your account. But it's 5 days, the worst case scenario. But you have that flexibility and access to your money. Okay. So investing does take a bit longer. Obviously, your goal is a bit more longer term. So some investments might be harder to access. For example, a retirement annuity, you won't be able to access that money until the age of 55. So that forces you to what I call disciplined savings, put your money away. Risk, so putting your money in the bank account, there's very little risk there. But obviously, you're not going to put all your money in the bank account and earn a little bit of interest because you've got inflation risk. The money, your money will be buying less money in a few years' time. So have some money involved in there, but there's less risk. So risk and reward go hand in hand, risk and return. So that fits in with the bottom part there. So you earn some interest in your bank account, but you're not going to shoot out the lights. So you want to go for higher growth potential. Obviously, higher growth comes with higher risk potential. They work hand in hand, and that's how putting your money in the stock market give you higher growth compared to putting your money in the banks. Okay, but you're being compensated for that. I hope that just made you give you an idea of those. Those are the 4 criteria you can look at. Okay, so saving and investing, people use the same terms, but they mean different things. It's like investing and trading. Trading is more short term, investing is buy and hold longer term. Okay, so it means it might mean the same thing, but they actually mean different. Okay, so let's move on to some of the investment products that PSG might have. So what's important here is that depending who you speak to, as I mentioned just now, is that the word save and invest could be used to describe the same thing. But also context also matters. You speak to a corporate executive who's considering putting away 10,000 Rand a month. You might not consider that significant, but someone else is just backing to put food on the table. 10,000 Rand a month is a lot of money. So context also important. So when it comes to the differences between the two of them, as I mentioned just now, putting money away in a safe, or saving money is putting your money away in a safe play to be used in the future. Investing is making your money grow, be it in shares, in unit trusts, or in property, but you hope your money will grow. So those are the major big things here. But the idea with the next few slides is to give you some scenarios. So this is some calculators you'll find on our website. You can go to the bottom here, you'll find there'll be a link to where you can find it on the website. But here's a lady that is putting 1,000 Rand a month away. She wants to build a bit of an emergency fund. She needs about 3 months income, 3 months expenses, about 60,000 Rand. And the calculator tells you that it's going to take roughly about 4 years to build up that fund. What's important is all these investments are invested into unit trusts. So unit trust is call it a basket of funds. A fund manager looking after you. But in this scenario, she decides to invest into the PSG investment manager cautious fund of funds. Gives you that high degree of capital stability, so it's a bit more moderate, but the goal is still longer term for at least 3 years. In this scenario, a goal is 3 years. Sorry, 4 years. There we go. So she's putting a monthly 1,000 Rand a month away. Her goal is 4 years. It calculates future value and adjust the contributions every year for inflation. And you can see after 4 years, she's putting away 53,000 Rand. That's what she's contributed. But her estimated growth will be 62,000. So she'll meet the goal if she sticks to that plan. Okay. But in this scenario, what's the best investment vehicle? Be a voluntary investment plan. That gives you that flexibility. She can take the money out, worst case scenario, 5 days, but also she's got a whole range of unit trusts to choose from. I just used the cautious fund as an example. We've got a scenario where Johannes wants to invest for his son, a bit more longer term. He wants to put 3,000 Rand away, a month away. He decides to use the tax-free investment plan. So you got a lifetime limit of 500,000. but also you got an annual contribution limit of 36,000. So he decides to go 3,000 Rand route, which is monthly to make up the 36,000. But also the reason why he goes monthly is he wants to take advantage of rand cost averaging. So he'll bring a lump sum in, wants to put monthly rand cost averaging in. Okay, so in this scenario, remember you've got a lifetime limit of 500,000, divide 36 into that, gives you a goal roughly about 13.89 years for you to, you can see there, you can see that's the money invested. But you can also see the growth that you could be able to get is more than double his money. So yeah, in this scenario, he wants long-term wealth creation. So he might look at the PSG. Also, again, the growth multi-manager fund of funds. Okay, that just gives you that vehicle that you can use for. Remember, you can take. He has access to this money. You can take it out, but you just can't put it back. So remember, you got a lifetime limit, annual limit. So if I put in 30,000 Rand this year and I take the 30,000 Rand out, it accumulates to my 500,000 lifetime limit. So this is, in this scenario, he's committed to investing for his son and for his son's education when he's much older. In this scenario, yeah, Simon wants to save some money for a family holiday in 5 years' time, and he's putting in like 120,000 Rand a year away. So every year he takes a lump sum, and he decides to use endowment as a vehicle. So he's got a 5-year restricted period. So he puts it every year, he puts it away. You can see he puts it away annually, 120,000 Rand. There's a 5-year period. His future value will be over 641,000. Sorry, 841,000 over the 5-year period. Okay. So also again, he's putting it into a cautious fund. He's a bit more moderate because it's a bit more shorter term. That's his risk profile. So it's a bit more cautious, and that's how you'll get achieve his goal. And then lastly, obviously, retirement annuities and another investment vehicle that you might want to use. So, you know, it's quite common again to hear people talk about saving for retirement, but you also more likely to be investing for your retirement, either through your compulsory retirement product for your employer, be it a pension or provident fund. We can also go through a voluntary contribution like a retirement annuity. So in this scenario, John is he's now 35 years old. He plans to retire at the age of 55. He's looking at a 30,000 Rand a month income before tax as a starting point. He has 1.2 million in his provident fund saved up already. And at this point in time, he wants to start a separate retirement annuity, and he can put 5,000 Rand a month away. Remember, he can put up to 27.5% of his total remuneration or his salary away a year, with a limit of 350,000 Rand. But in this scenario, he's happy to put 5,000 Rand away. Based on that criteria, okay, he'll be able to retire at the age of 55 if he makes a contribution of 5.9. So he might have to increase it a bit more, but you'll get out slightly a bit there. Remember, this is his monthly income might be slightly a bit less, or you might have to work a bit later, a bit longer. 1 more year extra, but it gives him that ballpark, something to work towards. In this scenario, he decided, okay, he wants to go into the PSG balance fund. He wants to be able to have exposure into offshore, but it's maximizing based on the regulations 28 criteria, 75% equities. In this scenario, it has 75% equities, but also a split between local and offshore investing. So that's why he's gone with this fund. So it gives you that access to various asset classes. Okay, so I hope that gave you some idea, but just to summarize it, if I had to put it into a nutshell, all the different, the 4 investment products I've just spoken about. The VIP, who's it suitable for? Anybody that's looking for growth, income, flexibility, and access to their funds. So if flexibility is important to you and a range of funds is important to you, then you're looking at the VIP. Okay. The contributions, you can start as low as 500 Rand a month. Lump sum, 20,000 Rand a month. You can also do ad hoc payments, and you can do a combination of these. You find that things are a bit tough this month, you can suspend your contributions. So it's very flexible, and you will not be penalized. Okay, as I said, you have a range of investment options to choose from. Anything with the voluntary investment plan, obviously, these tax payable on the income and dividend contributions. So um, obviously, you also have the CGT that's payable. You can take 40,000 Rand profit out per year. That's your exclusion rate. But think of the main advantage here is for longer term growth and flexibility. You can have access to your money whenever you want to. There's no fixed term with a voluntary investment plan. Endowment, there are some restrictions here, so a bit more tax efficient, but for someone that's going in a tax bracket of more than 30% plus. So it's not for everybody. For someone that's paying a lot of tax, this is a great savings vehicle. It's also someone that wants to do more estate planning, so you can have beneficiaries nominated to your endowment. But it's also, I find it's a very good way for what I call disciplined savings approach. You're putting your money away. You have access to it. You can take a loan against the money. But also, again, you've got that flexibility to invest into a whole range of funds. The big advantage here is that that pays out after 5 years. It pays net of tax, so you have to worry about tax when the investment gets paid out in 5 years' time. Tax-free investment plan, we spoke about it just now. This is someone that wants to generate that tax-free capital growth, either from obviously capital growth or income from dividends and from interest, or that kind of growth over the long term is tax-free. Okay, so it's only available for individuals. No trust or companies can get involved there. Again, with all these investments, you can see all those contributions all the same. Okay. With the tax-free, the universe of funds to choose from is a bit smaller. It's about 94 funds you can choose from. So it's only the funds that we call the E-class or the clean class funds that you'll be able to choose from. There's no rebates and things like that. So it's just simpler funds to choose from. Okay. And then lastly, the retirement annuity. This is, as I say, it's great for ideally designed for retirement. Your contributions are tax deductible up front. So again, you can put up to 27.5% of your income per year into a retirement annuity. And then obviously it's to build up that nest egg when it does get to retirement age of 55, you'll convert this over to a living annuity up to 500,000, or a third gets paid out as a lump sum. But the other 2/3 has to be invested into a living annuity for that monthly income for you. And then you can choose between 2.5% up to 17.5% of that investment to be paid out either monthly or annually or biannual, whatever the case might be. Okay. But there are certain restrictions when it comes to accessing it. The main thing is, yeah, you can't access it before the age of 55. Okay, so I hope that made some sense to you guys and gave you some food for thought what investments you want to go into. So just quickly, we spoke about South Africa's got a negative savings rate because we're not saving enough because we're living in champagne lifestyle, as I call champagne lifestyle and beer income. So we need to start changing that. We need to change our investment habits and savings habits, and it starts with us teaching our children how to do it. We spoke about the 5 reasons for saving, obviously long-term security, working towards financial independence, being debt-free, but also being able to take the calculated risks. You have more freedom of choice, you have more peace of mind and things like that. I believe that also you'll have less stress if you're more financially secure. And then lastly, obviously, you can get your compound interest working for you. Okay. And we spoke about the 4 investment vehicles at the bottom here. These are just the normal traditional vehicles available to us. Some are a bit more capital efficient. Be aware of that. Okay. So guys, quickly before I wrap up, you can find these key information documents on our website. You can follow these links. Gives you more information about all these different investment products. Obviously, as I said, this webinar is being recorded. Go through this presentation. I'll be sending you the PDF of the presentation too. Any questions you have, you're welcome to give me a call. There's our number there, 0860 000 368. Or you can also email us on the wealth box. We call it the wealth box, wealth@phg.co.za. But yeah, let me see what kind of questions you guys have before we taking out Okay, the sound box. Is that what I said? The sound box. Ah, did I mistype it? Sorry. Sanjay, please type it in the question box. Okay, because you had me there. Cool. So here's a question from Gerard. What about local and offshore shares as savings and investment vehicles? Okay, yeah, I've obviously limited the presentation to that. So investing directly in the share market can obviously be appealing, but it's not suitable for everyone, Gerard. So number one, obviously the starting capital. Although we don't have a minimum investment, you've taken into consideration the trading costs. So, as the size of the trade increases, the brokerage rate decreases. So our minimum brokerage is 230 Rand per trade, up to 25,000 Rand. Obviously, that's excluding VAT. So that's number one, is your costs. I suggest is that you maybe, it depends how much money you got, but also what's important is, again, if you've got a small amount of money, you're at risk. So you're going to be able to build a diversified share portfolio. So rather look at a unit trust, or if you really want to go the shares, you could have ETFs, exchange traded funds, for 5,000 Rand. Just understand your costs would be quite high, but yeah, at least diversifying your risk. So so risk is important. Also takes time and knowledge to gain more knowledge about the share market. Most people don't have that. And also the diversification, I believe the biggest challenge is diversification. For most people, and that's why I've concentrated on this presentation on the unit trusts, those investment products, you can start a little 500 Rand and build up capital from there. Down the line, you might start a small or share portfolio as a little hobby and learn about the market, but for most people, it's not ideal. Offshore, also very similar. Again, not for everybody. Obviously, you want to go offshore if you want to diversify your portfolio, diversify your investments geographically. So that's assuming that you've got a share portfolio or investment portfolio here in South Africa already and you're worried about risk, then you go consider taking money offshore. Again, there is a minimum investment with offshore share portfolio. Minimum is £5,000, roughly about 100,000 Rand. Converted into dollars is about $6,000. You can't really do much building a diversified portfolio of that. We actually recommend more than that, R1 million plus, to build a well-diversified share portfolio. So yeah, going offshore, diversified geographically, that's the main reason, yes. Second reason, obviously, taking advantage of opportunities not available in South Africa, be it the FANGs, the Facebooks, and the Amazons, and the Netflix, the Googles, etc. That's another reason why you might want to go offshore. You can have exposure to offshore through ETFs. We can even have exposure offshore through unit trust. We've got a lot of global unit trusts you can have access to. Okay. So, sorry, Gerard, I hope that answers your question. Again, it's, the offshore is for more the advanced investor, I believe, because there's more risks involved, be it political risk and exchange rate risk and interest rate risk, etc. So it doesn't look like there's any more questions. Okay. Well, guys, thanks for being on this webinar. Let's take us out the way. Until next month, I appreciate you being on this webinar. Let's move us out the way. Bye for now. See you next month.